At the end of 2016, 11.3% of Canadians' investment fund assets were invested in index funds and similar passively managed products. Our neighbors in the United States are ahead of us, with 34% of their investment fund assets invested this way. In 2016, Canadians added $10.9 billion to passive funds and $10 billion to actively managed funds. Pretty even. In the US, investors added $490 billion to passive funds and removed $326 billion from actively managed funds. The evidence is clear. Our neighbors down south are catching on, and Canadians are intelligent people. So what's going on? I'm Ben Felix, Associate Portfolio Manager at PWL Capital. In this episode of Common Sense Investing, I'm going to explore why Canadians have been so slow to adopt index funds. Put yourself into the shoes of an average Canadian getting started with investing. Where do you go? Well, if you're the average Canadian, you probably go to the bank. Sounds like common sense, right? Well, let's see. Canadian banks don't generally train and incentivize their financial advisors to sell index funds. They train and incentivize them to sell the bank's actively managed funds, which have higher fees for the client and are more profitable for the bank. And we know how relentless the banks are in ensuring their own profitability. If you don't go to the bank, you might look online or ask a friend for an introduction to a financial advisor. There are plenty of non-bank independent financial advisors in Canada. The compensation model for these advisors has generally been commission-based for a long time. It's only very recently that financial firms have started offering and promoting other compensation models. As it stands now, many financial advisors are still paid by commissions associated with the high-fee mutual funds that they sell to their clients. Index funds do not generally pay these types of commissions. I've talked a little bit about the incentives that might be keeping dollars flowing into actively managed funds in Canada. The other important factor is our regulatory environment. In the United States, registered investment advisors have been seeing massive growth and are currently managing just under a quarter of investment assets in the US. This specific type of registration requires the advisor to act as a fiduciary, in other words, to act in the best interest of their client. This may seem obvious, but Canadian financial advisors do not generally have a fiduciary requirement. They have what is called a suitability requirement. What does that mean? Well, if an advisor in Canada recommends a high-fee mutual fund that will pay them a large commission but is suitable for the client based on the client's situation, the advisor is operating within the law. Not exactly ideal for the client. The suitability standard's partner in crime has been, until recently, lax requirements on fee and performance disclosure. Many, if not most investors, have not known for many years how much they're paying in fees or how their investments are actually doing. And advisors have not been required to explicitly state those figures. New disclosures now require financial firms to send their clients an annual report disclosing the total fees the client has paid to the firm and the performance that the client's investments have delivered. Between an incentive and compensation structure that heavily favors high-fee actively managed funds, the lack of a fiduciary requirement for advisors, and until recently, lacking fee and performance disclosure rules, it is no wonder that Canadian investors have not been pulling money out of actively managed funds and pouring it into index funds at the same rate as our neighbors across the border. Join me in my next video, where I explain why actively managed funds have such a hard time beating the market. My name is Ben Felix of PWL Capital. This has been Common Sense Investing. I'll be talking about this and many other common sense investing topics in this series. So subscribe and click the bell for updates. I'd also love to hear from you as to what topics you'd like me to cover.